And I'll test everything to make sure people can see and hear us. There we go. Awesome. So everything is showing correctly on our end. So yeah, hi everybody. I'm Gabriel Rucker. I'm the CEO and co-founder of Founding Titans. I'm here with Jake O'Shea, principal at Antler. And yeah, let's jump into everything. I'd love for you to kind of give an intro on yourself, Jake, and then we'll talk a little bit about Antler, ask a couple of different questions as we go through.
Sure. Hey everyone, my name is Jake O'Shea. I'm a principal on the investment team here at Antler in Austin. I grew up in Houston, Texas, a suburb called Kingwood. In high school, I was a competitive debater, so that led me to go to school at UT, studying political science and government. While I was there, I did a political internship and really quickly realized that government is not a place for people that want to really get things done and make an impact. So that led me to a bunch of random internships while I was at UT in and around the Austin area, and got really lucky and landed at a startup and was in kind of like a executive coordinator role, doing a little bit of everything, but really loved the environment and the experience of kind of working on a small team, solving real problems for the business and actually having an impact on the way it was run. So that kind of, inspired me to want to work with more startups. And so started going to events, joining clubs, just whatever I could do to kind of get more ingrained into the ecosystem. That led to, meeting a guy named Nick Spiller. He's currently a principal at Capital Factory. And he was my first manager, actually. So he hired me out of school at UT to join Capital Factory. There, I started out on the investor relations team. So really helping their portfolio companies connect with downstream VCs and raise seed and Series A rounds. Learned a lot through that experience and really had to build out a lot of infrastructure and like a data backend to make me more effective and efficient at my job. So make it easier to query companies, to create lists that I could share with potential investors. Through that process, kind of got promoted a couple of times, started managing the investor relations team, and then eventually the mentor team and the VIP team. By the time I left, I was the head of platform. And really the job there was building the infrastructure and helping determine how Capital Factory supported companies in its portfolio program. From there, had the opportunity to join Foundation Capital as their first head of platform. Foundation Capital is a 35, I think at this point, year old firm based in the Bay Area, in Palo Alto and downtown San Francisco. They're mostly doing fintech and enterprise AI investing. And this was in, kind of early 2022. So was really kind of enjoying the experience of being able to see some of these early advances in LLMs and AI before they were kind of public knowledge or publicly available. So spent a couple of years there, really built out a lot of, again, the infrastructure that they use to support companies and also their executive network. So it's about 100 Fortune 500 VPs, heads of engineering, heads of sales, people that could act as expert advisors and also potential customers for their portfolio companies. So started that program, built out a lot of the tooling, and then scaled that up to where we were making about one customer intro every day. And then had the opportunity to come over here and join the Antler team in Austin. And here at Antler, my job is primarily to source founders for our entrepreneur residency program, then work with them throughout that program. And at the end of the day, end up investing in the ones that we are most excited about. And then once we invest, my job is really to support those founders, helping them focus on growth, acquiring customers, and executing their go-to-market strategy. And then also raising downstream fundraising. Usually that means their seed round or their Series A round. And that's a little bit of my background and my story.
No, that's awesome. Yeah, actually, it's crazy. I think I met you like a while back. I think through the Capital Factory connection, and yeah, I know that you had briefly talked with the CEO of the last startup that I was with, Colby Harvey, over at what is it called, founding over at Rise, now UltraView. Yeah, and so it's really awesome. Everything that you've kind of accomplished and how you just keep moving up in the venture community. Definitely inspiration to me and a lot of other people. And I know you also do a lot of things, especially for the AI community and not just the venture community out here in Austin as well. And so, yeah, let's dive right in. So, based off of your expertise and extensive experience in various roles across different venture firms, how do you define the key components of venture capital that every founder should understand?
Sure. So venture capital is just a style of investing. It's an asset class essentially, and what that means is that venture capitalists are investing other people's money. They have investors themselves. They're called LPs or limited partners. The job of a venture capitalist is to take that money from venture or from their LPs and then invest it into very early stage startups and then produce over the 10-year life cycle of the fund 3 to 5x overall returns on that initial invested capital. So if you have $100 million fund, your job is to turn that $100 million into $300 to $500 million of returns. The reason that VCs exist really is to help institutional investors, those LPs, have non-market correlated returns, right? So these large pension funds, the LPs that invest in venture capital funds, they're also invested pretty heavily in the stock market, into stocks and bonds. And when there's a downturn in the stock market, they need some way to hedge that risk. And so startups are a really interesting way to do that because, startups have such a long investment time period and overall such a high ceiling of total possible returns that it's not really correlated with the market, right? Even if the market is going on a downturn, startups can be doing really, really well. And so that's one thing to understand is just VCs are basically capital allocators that have their own investors, and their goal is to return 3 to 5x the amount of their total fund to their investors. Second thing to understand is that means a few things for you as a founder. One is that VCs are really only interested in investing in companies that could eventually be worth $1 billion or more. And the reason for that is just kind of basic math, right? If let's say a VC fund invests and owns 10% of your company, right? And let's say that they don't get diluted at all. So they own 10% of the company at the time of exit, and they have, call it like a $200 million fund, right? So if the company ends up being acquired for $100 million, right, and you own 10%, then that investor returns $10 million to their limited partners. But that's $10 million out of $600 million total that they're targeting their returns for their investors, which is like 1.5%. So it's not really a good outcome, even though by all means, or by all other measures, $100 million acquisition is a good outcome. For a venture capitalist, that's not a good outcome because it doesn't return a significant portion of their fund. So I think just like the scale and the math is something really important for founders to understand and internalize, because the vast majority of companies are not right for venture capital, right? If you're willing to sell your company for $100 million, which, like, frankly, if I started a company, I absolutely would be, then venture capital is not the right asset class for you. Separately, if you're selling into a market where the overall market size is maybe like 1 billion or 2 billion, then it's probably also not right for venture capital because the odds of you getting to like 50 to 80% penetration in that market and therefore being worth like $1 billion or more are just very slim. So that's another thing that I think is important to know about venture capital. And the last thing that I think is really important that VCs don't talk about enough is ownership targets. So almost every institutional fund has some level of ownership targets, meaning for their initial investment, they want to own a certain percentage of equity in your company. And the reason they have those ownership targets is because that's what they use to model off their fund, and that's how they kind of measure their returns. So most institutional seed funds are looking for 10 to 20% ownership on that initial investment. And so for you as a founder, what that means is that you can kind of back into the valuations that they look for. If you understand, okay, the company looks for 10% ownership and they write $1 million checks, then 1 million equals 10% of 10 million. So their average valuation is going to be $10 million. The reason this is important is that if you're a founder and you're raising, call it like $500,000, but you want a valuation of $10 million, you're only selling 5% equity in the company. And so that means that for most institutional VCs, even if they really like you, they really like the company, the growth, the direction, et cetera, it's just not a fit from a thesis perspective because they're not going to be able to acquire enough ownership on that initial investment because you're not raising enough. for them to hit their ownership requirements. And those are, I think really under discussed in this industry, which is that, when you're raising institutional venture capital, you're selling 20% of the company on average for each kind of round. For the seed round, for the Series A round, starts to go down a little bit as you move up that capital stack. But for seeded Series A, you should anticipate selling 20% ownership. And that's what the VCs are looking for as well. They're looking for their check to go own, 12 to 15% usually off of that initial check alone.
No, those are all amazing insights. No, I mean the biggest thing, I think founders don't take into account is like there's a difference between founder math and VC math when they're actually going through and figuring out, is this a venture backable company, right? And I mean, you hit all of the high notes on exactly what that actually means to companies really at any stage. This isn't just for pre-seed or seed. It's really like Series A, Series B, and later on. To where no matter what, there still needs to be a significant return, or just an ROI period that isn't what you're going to see with the 99% of bootstrap companies.
Yeah, for sure.
And so let's go into the evolving landscape right now, because a lot of things have definitely changed over the last couple of years with how people are investing. So how has the investment landscape for startups evolved? And what should founders really, be aware of when seeking funding?
Yeah, I think a few things have changed, particularly in the last year, 2 years. One is that there's less funds out there. There were a lot of new funds that were raised in 2020, 2021, 2022. A lot of those firms have exhausted their dry powder, meaning made all the new investments that are enabled by that fund. And they're struggling to then raise their next fund so they can continue making new investments. So what that means for founders is that overall there are less of these first-time VCs or smaller funds out there to go pitch to and raise from capital. And so that necessarily means that there are less companies getting funded because there's less investors out there giving out funding. The second thing is that I think the bar has raised. The kind of metrics that investors were looking for in 2021 or 2022, the bar has kind of shifted, and now companies need more traction to generate interest from those investors. And I think the third thing that's changed is people are a lot more interested in seeing a near-term path to profitability, right? Whereas in the past, when capital was a little easier to come by, it was feasible for a company to go out and raise 4 or 5 times before they reach a stage of profitability. Whereas now I think investors want to see a pretty clear path or understanding from the founder, like, okay, we're investing now. That's going to enable you to grow to this point. And at what point along that path do you get to where you're, net break even or net profitable with the business? And I think that's a little bit of a shift from the past. In terms of what founders should be aware of when raising funding, I think one is just to understand that investors aren't interested in investing in like a chicken and egg problem, right? Every startup has some version of this where it's like you need product to get customers, but you need customers to raise investments so you can build the product. And it's just really a non-starter for most VCs is they want to see founders figure out a way to hack that cycle and to bootstrap their business, whether it's in terms of customer acquisition, getting those early customers, building, shipping product, et cetera, really finding some way to shortcut that loop and just get into market. Investors also don't want to invest in paid marketing. You should have organic funnels and ways of reaching your target customer that results in sales and new deals. That doesn't involve just pumping a bunch of money into Facebook ads, Google ads, et cetera. And that's maybe another change is that it's a lot harder to justify the ROI on some of those outbound platforms, like in terms of keyword optimization, SEO, but paying for Google ads or Facebook ads, et cetera. Investors don't really want to invest in you validating an approach for that. If you've got you've measured out, you're like, hey, for every dollar I put into this system, I get $1.50 out, then you can get an investor to kind of back you doubling down on that and continuing to push that funnel. But before that, investors are not interested in investing in those types of businesses or opportunities. They're really looking more for some sort of flywheel that's already somewhat spinning. And their investment helps you double down on what's already working, capture more of that market, and grow your revenue. And at the same time, start building more features, more product, start entering into these adjacencies that long term will make the business a lot more valuable.
Yeah, no, that's perfect for a lot of the points that you were addressing there, and I kind of want to shift focus a little bit here. So, with the transition from the role at Capital Factory and some of the other funds now to being principal at Antler, how did those previous roles shape your approach to managing and supporting startups, and what lessons did you bring to Antler?
Yeah, good question. So my prior roles have been much more focused on the platform side, which is basically how do you support startups that you've already made the decision to work with or invest in. And so there's like a few frameworks that I've kind of taken away from those experiences. One is that the three main ways you can help an early stage startup founder is fundraising, so introductions to other investors, customer intros, right, connecting them with potential customers that fall within their ICP, and then hiring, right, helping send qualified candidates their way or funnel great people to help join their team. So I've definitely kind of taken that with me in terms of the types of projects and tasks that I try to roll up my sleeves and help portfolio companies with. There are other things you can do. You can help like create a content or a blog or an article for the founder, or things like that. But ultimately, if you're not driving one of those three types of value, investor intros, customer intros, or potential hire intros, those I think are things that I try not to spend my time on. Try to focus everything on driving those three things. Second thing that I've taken away is just that the job of any platform function, in my opinion, is to increase transparency of who is in the firm's network, right? Make it easier to understand who everyone in the firm and every one of the portfolio companies is connected with. So mapping out that network. And then second is reducing the friction to access those connections. So make it as easy as possible to say, okay, Jake knows this person, and here's a really easy way for Jake to introduce me to that person. And so I try to basically just like apply that when I'm working with portfolio companies or with companies in our residency by kind of making my network transparent and saying like, hey, here's ways that you can see who I know. And here's mechanisms that you can use to make it really easy for me to connect you with those people. There's not really any kind of systems that I've built out for that yet here. But like one example would be like, hey, here's a list of investors that are kind of on my like close personal network. And if you want an introduction, here's a way to write a forwardable introduction email that I can just click forward on and send to that person and say, hey, would you like to meet with this founder? They're doing some really interesting stuff. So trying to kind of operationalize that. Other things I've taken away, like one, Antler is very hands-on with the founders that we work with. And so a lot of just the things that I've learned about building go-to-market funnels or positioning cold emails or building an investor funnel and kind of creating a basic financial model to understand how much to raise and when to raise and things like that. I try to take that and apply that to my work with startups here in Antler as an investor. And then second, like all those roles, I had to build lots of like mini tools and systems that drive value for founders. And so I'm continuing to kind of build out some of those tools and systems. And then basically like sharing them with portfolio companies, but also trying to share them more broadly with just any founder that could get value from them. So like one example of that is like this week, yesterday, I posted about, I created like a brand guide generator. So just really basic, like high level stuff you'd pay a marketing consultant money to do for you. Now you can just enter info on your company and I'll generate like a basic 75% good version of the same thing for free in like 45 seconds. Another example is a Reddit post idea generator. So I know a lot of founders end up wanting to look on Reddit to find potential customers or to market their product. So I created a tool that lets you put in a subreddit and then a little bit about what you're looking to promote, usually like your company or service. And then it scrapes the top 10 posts, extracts sentiment, extracts topic, and uses those to generate 3 ideas for your business that could potentially work on that same subreddit. So trying to keep that same kind of like systems approach and mentality to now the investing work that I learned from the platform work.
Yeah, no, I mean the VCs and the funds and especially the accelerators that actually kind of continuously build out those tools to continue to support the founders is one of the most important aspects, especially on the platform side, like you're saying, and customers and hiring. Everybody always kind of thinks my biggest need right now is fundraising, right? But like after you actually get those funds, what do you do with them? Because you don't want to just take that money and essentially piss it away, right? You want to make sure that you're actually putting it towards the right areas and continuing to drive growth so that you can at some point sustain yourself without the use of venture capital, right? I mean that's the goal for it should be the goal for everybody is providing that return, but also like, hey, if you don't need to take money immediately and you're able to just continue to scale until you get to that point where you have enough runway and are able to continue to operate. Like I've seen Series A companies very recently that are like, hey, we're not going to raise our Series B right now because like we're already, making millions of dollars. We already have the revenue metrics that we would have essentially raised for. And so we're going to use that capital to scale. And then, if we do need a Series B or later, we're in a much better position for the company's valuation, which is, I think the best way to do things. And I think a lot of people agree with that. And I mean, it's exactly what you were talking about for like the investor lists and being able to, provide those templates and things. I mean, definitely, we've talked about it a couple of times, but let's talk offline about that stuff with Founding Titans because we're building out some of those tools and also that Reddit scraper. I know we've talked about it, and I'm extremely interested in that sentiment analysis that you built out there. But yeah, so let's switch back into the fundraising environment. And what are the current challenges and opportunities within the fundraising environment right now that you see, especially with the early stage startups?
I mean, we kind of talked about this with just the kind of evolving investment landscape. I don't
Yeah,
know that I have too much more to add. I think the challenges are pretty much the same, which is that you've got to figure out some way to short circuit that chicken and egg problem. You've got to find some way to validate customer demand, to prove that you can ship. I think opportunity wise for startups, just start building relationships with investors early before you ask them for money. At the end of the day, this is still a relationship business. And if you're going to enter into a relationship with this investor for the next, 7 to 10 plus years as you build this company, like they want to underwrite what it's like to work with you. And the only way to do that is to know them for an extended period of time. So I would say like talk to investors early, and you can position it as like, hey, we're not raising right now. We know that it's too early, but we know we're going to need to at some point in the future. In the meantime, like, here's what I'm working on. What do you think about it? What are the opportunities you see? What do you not like about it? Does it make sense for us to keep in touch when we do eventually fundraise? And what are kind of the metrics that would get you really excited to invest in the company?
yeah,
Just do some of that information gathering for yourself, and that will help you really dial in like when is the right time to launch a fundraising round, but also make that process more efficient because now you're not meeting these people for the first time and asking them for millions of dollars. Now you're just catching up with someone that you already know, that's already watched you execute for an extended period of time, and it'll make those conversations a lot more effective and efficient.
yeah. I mean, this is a question to kind of branch off of that, but how can founders? I mean, you highlighted some of the topics, but I want to dive in a little bit deeper, like building those relationships with VCs, because really at the end of the day, especially in the earlier stages, they're really investing in the founder. All the other things have to pass diligence and all of that, but at the end of the day, it's is this person able to be able to take this to the next level? Is this person capable of listening and acquiring the skill sets to actually, build $1 billion plus company and assemble the right teams and do all those things. So like, let's talk about some of those, common pieces of criteria that people are really looking for to get that first meeting. And then during the diligence process, once they get to like meeting 2 through 4.
Sure. I think it's important to understand that there's 3 types of risk that VCs are underwriting. One is technology risk. Does the tech do what you say it's going to do? For most software companies, this is pretty straightforward. If they can use the product and see the product do what you says it will, that's a great way to kind of underwrite technology risk. For deep tech, biotech, hardware, that becomes a little bit more challenging. But it's still fairly straightforward. It's just, does the technology do what you claim it can do? Second is market risk. And that's like, will people buy this product, and will enough people buy this product that it can eventually build a company that scales to 100 million of annual recurring revenue, right? Which also is about like $1 billion in valuation most of the time. For that, the way that investors underwrite it is they talk to potential customers and you show them yourself closing potential customers. So again, not the most complicated to underwrite. It's all about like, can you sell this product, and is the market overall from a bottoms up perspective, meaning number of potential customers times revenue per customer, big enough to fit kind of their investment model. And the third piece is execution. And that's, can this founder take this technology and sell it into this market and basically execute on their plan to turn this into a big company? And this is not straightforward to underwrite. This is where when people talk about being kind of like founder focused, this is really like what they try to dig into and underwrite is the ability to execute. And again, the best way for them to execute is to watch you execute over an extended period of time. That's the best way to underwrite execution. And so that's, again, why it's so important to talk to investors before you're asking them for money, so that now, 4 months later, they've watched you execute and you add them to investor updates. And you're like, hey, 4 months ago, we said we were going to do this, this, and this. And here we are. We did all this stuff. Now we're going to go do this, this, and this. We need this much capital to kind of enable us to go do that. So that's kind of how I would think about overall what investors are looking for and the types of things that they're trying to build conviction on is technology risk, market risk, and then execution risk. In terms of like getting that first meeting, cold email really does work. It's just important to be intentional with it and not blast it. So one, with any cold email, shorter is better, right? Adding a ton of information is not going to make people more likely to respond. It'll probably do the opposite. So just write a short, thoughtful email. Say like, hey, investor, saw something relevant to them, right? They released a post that's relevant to the company you're building. They invested in another company in kind of a similar space. They just closed a new fund. One of their portfolio companies just raised more funding, like something to show them that you know who they are and you're not just blasting this out to everyone. Then say, I am so-and-so, I'm working on this, right? Like quick elevator pitch, and then help them understand why this matters to you, right? If they're going to invest in you building this company for 7 to 10 years, at least, they want to understand like your personal connection to the problem and why you're the right person to build this. So include some kind of snippet or tidbit about that. And then just do 3 bullet points about the traction, right? We've closed this many customers, or we've done this many customer interviews. We've just launched this feature. We've got this in the pipeline ready to go. Like 2 or 3 things to get them excited. And then say, hey, I'd love to kind of meet you, share more details on what we're building and get your feedback on it. Like, would you be open to a quick 20 to 30 minute chat? So that's kind of how I would approach getting some of those initial meetings. For people that you have some sort of warm connection to, the best way to get a meeting with a VC is an introduction from another founder, right? So if there's a founder that they invested in that can make an introduction, that's almost always the best way to get on that investor's calendar. So that's another opportunity that I would explore. And then obviously just other warm introductions, right? Other investors of yours can maybe make introductions or connections. People on your team or people in your community, lots of your founder friends, they all have their own kind of networks of investors that they can kind of leverage to get you that first meeting. And in terms of diligence, this varies a ton firm to firm. I think most firms are, again, trying to underwrite those 3 types of risk. So that's mostly where the conversation is going to be spent, right? Let's look at your cap table, right? What does that look like? Is there room for us to come in, but also other downstream investors without over diluting you as the founder? What are kind of the technical documentations, right? What's the stack? What is it built on top of? What are customer testimonials? Can I talk to some of your customers and kind of understand what they use the product for, what they're excited about, what they need, what's the pain point? Just really getting to know the technology, the market, and you as the founder as well. So there will be questions about how do you think about building a culture? Like, what are some things you look for when you hire people? What are some strategies that you use to get in front of potential customers? Where do you see this business growing or evolving towards? Every fund is going to have different flavors of those 3 types of risk, but that's really what the diligence process is for, is digging deeper and building conviction around those different areas.
Yeah. No, love that, sentiment of, the community aspect, especially, the intros for other founders actually, even for our company, has gotten us a couple of really great meetings, over the last, month or two, and, really continuing to build up those relationships, is extremely vital. And I think people kind of discount, that sometimes. I mean, being able to reach out to, one of the other previous portfolio companies and really asking like, hey, what is your experience with this fund? If they're in your top five, just establishing those relationships as well as the relationships with, the managing directors or, the principals or just pretty much everybody else on the team. Because those are the individuals that are going to give you that impartial advice. I mean, I've had founders actually tell me a few people that may not be a good fit based off of, just how we operate and how we think about things. Not that it's, a bad firm or anything else or a bad fund, but just that, how we are looking to approach things, like being able to just kind of make that decision. Because it's also like an evaluation on both ends, right? Where the founder is evaluating as well as the fund is evaluating as well. And I know a lot of people, and I'm sure you do as well, that have turned down checks. Sometimes in the ranges that you kind of maybe beat yourself up on later, but then ultimately, if everything works out, it was the right decision. I mean, hell, even Facebook with Zuckerberg, some of the offers that he got for Facebook in those early days, it's crazy, right?
Yeah. I mean, the investment period is longer than the average marriage in the US, right? So you want to be really thoughtful about who you want to work with for that extended period of time and that closely. So yeah, definitely it's kind of both sides need to evaluate if it's a good fit.
I'm just letting you know I'm going to steal that from you, by the way, for that quote.
I stole it from someone else, so it's not my quote, but yeah.
Sounds good. So can you talk about some of the success stories, or I know you've talked about some of the key lessons and everything, but just success stories you've seen with some of the portfolio companies for like Antler, while your time at Foundation Capital, maybe even Capital Factory, that you want to highlight, and their effective strategies that they used for growth and for their investment process.
Yeah, I mean, I'll give one from kind of the Foundation Capital time. Foundation was the first investor, the first institutional VC investor in Jasper AI here in Austin. That's one of the fastest companies to hit 100 million in annual revenue. It's now a unicorn. It's I think it's probably the most recent Austin unicorn. If not, it's like close to one of the most recent. And that was one where the general partner, Joanne Chin at Foundation, had known the founder for a long time, saw the technology, and this was before language models were widely understood, and just basically had like a magical experience interacting with the product. And so led their seed round, and then eventually the Foundation's growth fund doubled down when they raised at the unicorn valuation. She's on the board, and so that's a big success story. Like one of their secrets was they kind of started with a bottoms up growth strategy. So really focusing on the individual marketers that were using it to optimize their own processes and their own output and copy. They built kind of like a cult following with these people. And so used that to get a lot of early traction. But then at the point that the market started to become more saturated with other competitors, they then ended up actually switching their strategy to focus more on larger enterprise customers. And they were able to do that because they had scaled up to a point where they were a known quantity, and they had some of these larger enterprise deals already closed. And so they had the ability to then wean off of the smaller contracts, the more SMB type opportunities, and just shift their focus full time to servicing these really, really large, high contract value enterprise contracts. So that's kind of one example where they started with just solving a really specific pain point for a really specific type of customer, which was kind of the individual marketer. And then we're able to build on top of that and compound to the point where now they can go after bigger customers. And eventually they just shifted their focus entirely over or majority over to those much larger customers. I think that's a strategy that can probably be repeated. At Antler, we're really young here in Austin. We've only really been around for a little less than 3 years, since late 2021. So there's no like huge breakout success stories as of yet, but I have a number of companies that have done pretty well, continued to grow, raised large priced seed or Series A rounds. One example of that would be Endless Health. Endless Health does testing in workplaces and also just for consumers generally. They just closed a price round led by Next Coast Ventures here in town. So really excited for them. One of the companies that I invested in, a company called Symbi AI, they apply AI to scientific research. So help validate claims made in scientific research papers, then also automatically replicate experimental results. So if they include data sets or different code in the research paper itself, Symbi's platform will automatically replicate that data and validate whether or not it's accurate. They've been really crushing it. They have a number of term sheets they're looking at right now. Don't want to share any details on that because they're kind of
Of course,
evaluating
yeah.
their options, but they're in a good situation where they've got a lot of interest and also have been closing large 6-digit enterprise contracts as well. Just a couple of weeks ago, got word that they closed really big name brand kind of Fortune 50 enterprise, and they're continuing to kind of have those conversations. So still very early days, but feel pretty excited and confident that that's going to end up being a success story too. And then from Capital Factory, there's just a ton. Their portfolio is 300 to 500 companies.
Yeah.
A couple of specific ones. One is Aptronic. They're a company that builds humanoid robots. That's a company that Capital Factory has been investing in from the seed stage. They have a signed contract with NASA now to kind of deploy that technology at scale for NASA. So really excited there. They're also investors in a company called Intuitive Machines. That company is now actually publicly traded and landed on the moon earlier this year. So just really, really exciting companies in that portfolio as well. Those are some of the success stories.
Yeah, no, I mean, I love that. And I love that like definitely are able to just talk about the like impact on them. And it sounds like you're still keeping in touch with at least the, ones at Antler and probably some of those other ones as well, just to kind of keep tabs on them, which, just proves that, your approach that you actually give to these companies is more than just the status quo, but what you've seen. Because you'd be surprised at how many people that I've actually asked, like, "Oh, what is your favorite company?" And maybe they could name like one investment that they've seen that's really caught their eye. But the fact that as you progress through your career, like there's a couple that still just stand out in your mind even to this day. It's fantastic. And so let's see, for switching gears here, because you actually answered a couple of the other ones that I had listed here as we were going through. Actually, let's talk about your advice that you would have to current investors and future VCs. So what advice would you give to new VCs preparing to raise their funds, as well as people that are just starting to make their investments?
Yeah, investors going to raise their funds, like I really don't have a ton of experience with that. It seems like quite a grind. It's not a fun time to be out there fundraising from LPs.
I meant
Because
like right after they actually like after they raise the fund, like not in their fundraising on the LP side, but specifically like once they start making those couple first investments for their portfolios.
Yeah, I think it's really just understand the dimension that you can move the needle on the most, and then really try to focus there. Don't try to do everything at once. Like this is startup advice 101 is don't boil the ocean. Have like a hyper specific pain point and get really, really good at solving that pain point for your customers. And your customer as an investor is the founders that you invest in. So I would say on those dimensions of like investor intros, customer intros, and like hiring intros, I would kind of pick one and try to really focus and divert your efforts towards helping along that one dimension. Just get really, really good at that rather than trying to commit to a lot of broad horizontal things and then like doing a mediocre or bad job at all of them. Just pick one and try to do it really, really well. I think the second is to understand that like your job is to support them in a lot of ways, but it's also to kind of make sure that they're mentally and emotionally in a strong place. So like make sure you're kind of asking how they're doing, what are they challenged with, what's good, what's bad, how are their personal relationships, how are they making time to spend with their family, with their significant others, with their children, things like that. Because like I think the number one reason that startups fail is not due to competition or anything other than just like not continuing to move. And it's been said that building a startup is kind of like eating glass. It's like not a fun thing to do. And so I think it's important for investors to keep in mind that like these are people too, and for people to be operating at 100%, they need to like kind of have their base physical wellness and emotional and spiritual wellness ready to go so that they can actually be effective in their job and in their roles. So that's maybe the advice that I would give.
Yeah, no, love that. And I know you've given a lot of advice for the founders as well. And so I don't want to, tie it back into that because we've already, given a lot of really good tips and tidbits as we've gone through. So for, your role in AI, right? Because you also, co-run AITX here in Austin. So I feel like this would be a really great question to ask you. How is artificial intelligence shaping the landscape of venture capital, both in the types of startups that are being funded as well as the strategies that investors are starting to adopt?
Yeah, good question. So I am a huge fan of language models and just generally new advances in AI. That's how I'm able to kind of code these miniature tools. Is like I wouldn't be able to do it if I didn't have ChatGPT helping me debug, generating some of the boilerplate code, all that sort of stuff. So um, really excitement around that is what led me to kind of start AITX and try to build up the community here in Austin a little bit more and just provide kind of an open, unstructured way for people to meet other engineers or other entrepreneurs excited about AI. How it's affecting venture capital, I think, like one, there's obviously tons of companies now that are popping up that are leveraging these new technologies. So what that means is that in the same way that every company today is kind of a cloud company, where you wouldn't describe like, oh, I'm a cloud app. Every company is built on some sort of cloud infrastructure technology. I think the same thing's happening with AI, where even companies that say, hey, we're an AI company, really they're just integrating AI at some level into their infrastructure. And a few years from now, I don't think those companies will all be calling themselves AI companies, because it's like calling yourself a cloud startup today, where it's like, yeah, obviously you're an AI company, or obviously you have AI involved in some way.
Yeah.
From a VC standpoint, I think in a number of ways we're trying to use it to sift through applications, right? So how do we take like this kind of boilerplate application? How do we learn more about the candidate and augment that information on the person that's applying using AI or using language models to generate additional context? How can we compare ideas that they submit to their professional background and see where those line up or don't line up? Lots of really interesting use cases there. I think for building tools, it's really impactful. So going back to what I talked about earlier, where if you're in a platform role, your job is to like increase transparency and reduce friction of who's in your network and how to access them. You can do some really interesting things with AI to basically augment your CRM or augment your network data to help better understand who do you know that's a potential customer, potential downstream investor, or potential hire for your portfolio companies. So those are some things that I'm kind of experimenting with in my free time. And I think also it has made it a little bit more difficult to understand from like an infrastructure perspective what opportunities are real and what opportunities are going to get basically like eaten by one of the big foundation model providers in the next 8 to 12 months. It's kind of difficult sometimes to invest in core infrastructure or even some basic applications, because there's always the chance that some new architecture comes out that makes this old one obsolete, or that OpenAI decides to release some capability or any one of the foundational models that makes it really difficult to justify someone paying for a separate subscription just for that one capability. So I think it's really just kind of infused the job in all levels and all aspects, both from like the way that you evaluate startups, your internal tooling as a fund, but also what you're looking at when you're underwriting or diligencing potential investments. It's kind of infected the entire stack.
Yeah, no, I mean, for actually, uh, going through every single process, especially even on the founder level as well, like, calling yourself an AI company doesn't mean that, you're generating, documentation, all those things with AI or whatever it is internally. Like, I think it's people that are actually, building out their own LLMs, like actually, building out systems that isn't just like a GPT wrapper that are actually, things that are really going to stand the test of time. And so, I do have another question kind of surrounding that as well, because we do see a lot of these companies and some people that have lost their shirts and investing in them to where, there's really nothing defensible. Like, some people just say, oh, it has AI in the name, I'm going to, write a check towards it. And I think people are starting to wise up to that, as time kind of progresses with, the adoption of artificial intelligence. And so, what advice do you have for AI startups looking to differentiate themselves, and succeed, I guess, in this current climate and really stand out as an AI company if they are building out AI, or, just really how to stand out in general with all of these AI companies kind of coming in to this, hopefully not a bubble, but,
Yeah. First thing I'll say too is like, I don't know that investors or lots of investors are actually just like throwing checks at AI companies or even were. I think there's always a tendency, especially in venture capital, to pattern match. And these people that are able to raise these multi-million dollar rounds pre-product, pre-revenue, 9 times out of 10, they've got some really, really interesting or exciting background that enables investors to build conviction in those three types of risk: market risk, tech risk, and specifically execution risk, that enables them to write that check, right? I think most VCs are actually pretty conscientious about when they deploy capital because, again, they have to answer to their LPs. So if they just write like a crazy check at a crazy valuation and the company goes bankrupt 6 months later, their LPs are like, dude, what are you doing? Like, what was the process? What was the structure? So I think a lot of times what we see of venture capital and of investments is often these like really big hype tech crunch articles. And I don't think that those are actually representative of the vast majority of companies that are raising venture capital. But to specifically address kind of like how founders should think about differentiating themselves when they're building AI products or AI platforms. I think overall, if I had to sum it up into one piece of advice, it's focus on the business problem. Don't focus on the AI, right? What is the core pain point or desire of your customers? And what's the value proposition that you provide that help them address that desire, right? That's all that matters. AI is just part of the technology that lets you distribute that value proposition that they can use to solve their desire or solve their problem. So I would say, like, don't talk about the fact that it's AI. Talk about the fact that, like, hey, there's this huge customer segment that we have talked a ton to, and we know that they all struggle with this thing. And we found that if we can give them this value proposition, it really helps them solve this thing. And they really want to pay us to do that, right? That's ultimately what an investor is investing in, is that core business loop of like customer desire value proposition. So just focus on that, right? The product is actually just the technology infrastructure to deliver the value prop. So to differentiate yourself, show how you're solving a real business problem. And the way that you solve it can be AI, but that matters way less than the fact that you're solving a real problem. It's a big market and people are really, really interested in paying you because you're solving this problem for them. That's ultimately
yeah.
what's more important than anything.
Yeah, I think that a lot of people actually, tie in artificial intelligence because it's a buzzword right now, but actually being able to tie in the actual, value proposition for the startup is something that, it's always tried and true. It's always something that's going to, work out. And if you actually don't have, a solid value proposition, or if you haven't actually talked to customers or reached out or anything like that, then, it's kind of just not going to work anyways, right? Like, you have to make sure that, it's a vitamin versus a painkiller. I know everybody always kind of says that exact statement, but are you solving a real need, and are people actually going to pay you for that need?
Yeah.
No, that's 100% agree there. And for everybody also, if you want to put in the chat any questions that you have, and then if not, we might be wrapping soon here. But if you have any questions for Jake, definitely throw them in there. But yeah, that's, something that I've even thought about, with Founding Titans ourselves is, how do we, articulate this of, we're using this AI, but, it's not the mainstay, or it's not the main value proposition. We're actually feeding in how to improve the lives of, the startups, the startup ecosystem, just our actual end users for the primary and secondary users. And, some people, have gotten upset with us because they're like, why didn't you say this was, an AI company? Let's frame it a little bit differently or whatever. Because really, at our core, we're a data and centralization company. So it's really interesting, kind of hearing you reiterate the things that we're actually doing, and how we're tying that in, because it's really vital and important. And so I think that there may not be anything in the chat right now that I don't see. If something pops up, then I'll make sure to bring it up. But let's go ahead and I'm going to post some of the links in the chat here for everybody to check out. So first one I'm going to drop in here for everybody is going to be the link for Antler. So if anybody wants to check that out.
I actually dropped a new one in there if you could use
it. Yeah, I made sure I grabbed that one.
Sweet, man.
Drop in. And going to drop in your LinkedIn and my LinkedIn as well, so that if anybody doesn't have that, they can connect with us. And finally, I'm going to drop the Founding Titans links in here. And if anybody wants to, go ahead and join our waitlist, we're building a community-focused relationship optimization platform for those of you guys that joined late. And we're building that to help pre-seed to Series A startups with finding the right connections and resources for their businesses. So I made sure I dropped all those links in the chat for you guys. And so, outside of those links, Jake, what are some ways that people can connect with you after today's session?
I think the best way is to just apply for Antler if it seems like our residency is a good fit. Our model is to work with founders for 6 weeks, get to know you, really underwrite your ability to execute the market, the technology during that time. At the same time, connect you with local executives, local investors, just people that can help you along the early days of building your business. And you're building a really great network of other founders. We have about a 2% acceptance rate and fill the room with between 75 and 90 really smart, talented, ambitious entrepreneurs. So if that seems like a fit for you, go ahead and apply at that link that I shared. And then other than that, it's just LinkedIn. Just shoot me a note. Happy to connect and answer questions.
Awesome, man. Yeah, thank you so much. And so next week we're actually going to have Micah Musa Perlin from Microsoft over on their M&A team to talk about mergers and acquisitions next Tuesday. And then we also have CS Freeland next Thursday as well to talk about everything that's going on with the Texas Venture Alliance, all the things that are going on in Texas right now, including the Texas Ventures Fest that's going to be coming up this October, and also some other aspects like the Venture Gala that they recently put on earlier this year, and some secret things that haven't been revealed yet that we're going to be discussing as well on that Thursday. And then this Thursday, we've actually, because we've got so much interest from some of the VC community and coming on and speaking, about their experiences and, specific topics and categories within the startup ecosystem. We've actually got Hark with Framework Venture Partners out in Canada as well. And so definitely make sure you sign up for that. And, thank you again, Jake, for jumping on. I'll make sure that I ping you after this to, talk offline about some of the things. And thank you again for, dropping all that knowledge and information, extremely detailed, extremely, just well thought out for a lot of the answers that you gave. And so I know I appreciate it. A lot of the other founders in the chat have as well. And I want to make sure that, if anybody didn't catch anything, or if you weren't taking notes during the recording, will still be there after, we exit this LinkedIn Live. So definitely make sure that you catch up on that information. For Founding Titans also, you can check out our links on Luma as well for all the upcoming events. We actually have webinars scheduled all the way into October, until basically the end of October this year. And so definitely come on to, hear about different portions of the startup ecosystem and really hear from some key players that are actually doing some amazing things for, early stage companies, late stage, underrepresented founders, as well as the communities and systems that kind of keep everything running in this ecosystem. So thank you all and have a great rest of your day.
Thanks, Ben. This was awesome. Appreciate you having me on.